We just got the latest job market data, which says that the unemployment rate in America has gone up from 4% to 4.1%, which really isn't that big of a deal. But there are three things that you want to pay attention to here that a lot of people are overlooking. Number one, our economy added less jobs than expected, and we're starting to see a trend where it looks like the job market is slowing down. Number two, as soon as this job market data came out, the Federal Reserve Bank, led by Jerome Powell, gave a statement where he said that investors don't need to worry because the economy is doing fine, with some insights as to what he is expecting with interest rates. And then number three has to do with tariffs. President Trump just put another 1 month pause on tariffs on Mexico and Canada on specific goods which fall under a trade agreement that was signed in 2020, and that covers a lot of goods. So all of this creates a lot of confusion. We've been seeing a lot of volatility in the markets, and that's why in this video, I want to break down what's going on. That way, again, you can be a smarter investor, not somebody who's being driven one way or the other by emotions. Let me start with what's going on in the job market. We saw less jobs than expected added last month, and we saw the unemployment rate rise from 4% to 4.1%, and we are seeing a shift in the job market. What I mean by that isn't just the federal layoffs that we're seeing happen. We're seeing, number one, employers are just generally hiring a little bit less aggressively. Number two, we are seeing companies do a little bit more layoffs. And number three, we're seeing companies pushing for more productivity. We've seen more companies push return to office. We've seen more companies try to figure out how they can become more efficient in the workforce. And the most interesting part of this is that we're seeing more companies slow down their investment into their business or research and development, which might have to do with the fact that consumer confidence in America has been falling. Consumer confidence is a metric that a lot of people on Wall Street and economists like to track. It's the measure that shows how confident consumers, regular people, are in the economy. In plain English, it means how confident are you that you're going to get a paycheck next month? And so when people feel confident in the economy, they feel strong that, hey, my job is safe, my income is safe, so I can keep spending money. When consumer confidence falls, like we are seeing happen right now, it creates more concerns, because when people are worried about their job, when people are worried about the economy, they're less likely to go out and spend and buy that extra guac, because if I buy that extra guac today and put it on my credit card, I might not be able to pay it back. Now, I don't recommend you buy that extra guac, especially when you can't afford it. But the reason why this is important is because our entire economy runs on spending. The more money you spend, the more money somebody else makes. And in this economy, people spend based off of emotions. Hate it or love it, that's the way the world works. It is unfortunate. I want you to spend based off of reality, but that's not how our economy works. People spend on emotions. And when people feel confident, they spend more. When people spend more, businesses make more. When businesses make more, well, that also helps the stock market. And so when people are worried about consumer confidence, the real reason why that matters is because it can impact spending, which can impact the economy, which can also impact the stock market. And what we're seeing happen right now is businesses are also slowing some of their investment because they're seeing what's going on with consumer confidence, and they're also concerned about tariffs, and they're not sure what's going to happen in the economy. And because of that, some businesses are saying, instead of investing all of our money, let's be a little bit more cautious. Let's not take on too much debt. Let's not get too aggressive, because we don't know exactly what's going to happen. So let's just put a little slowdown on investment, which means that businesses might not see as much growth, but that also impacts the economy, because that means that they're not investing in more growth. They might not be hiring as aggressively as well. So we're seeing a lot of changes in the job market. 2021, 2022, it was a very good market for employees because all the employers were looking for employees, and employees could be very picky and very, well, demanding. Now we're starting to see that shift where you're starting to see that evening of balance. So that's what's going on in the job market. But what's going on with the Federal Reserve Bank? And I know there's a lot of changes happening, which is why on March 11th, again, I'm hosting a free workshop where I'll be going over, number one, the changes that are happening in the economy. Number two, how you can build wealth and find the investment opportunity with all these changes, because the reality is volatility, changes, Doge, tariffs, all these things create investment opportunity for those that are financially savvy. This is what Wall Street understands, and the average person gets left behind. But that's what I'm going to be going over on my workshop. I'm doing it twice on March 11th, once in the morning at 10:30 a.m. Eastern Standard Time, and again in the evening at 8 p.m. Eastern Standard Time. It's completely free, but we don't have a ton of seats available left. We have a lot of people that have registered. So if you want to join, I have the link for you down in the description below. Talking about the Federal Reserve Bank. So Jerome Powell, who is the chairman at the Federal Reserve Bank, said that our economy is fine. It doesn't need us to do anything, and we can wait and see what we need to do. What does that mean? Well, the Federal Reserve Bank is the entity that's in charge of controlling interest rates. When I say interest rates, I don't mean your mortgage rate or your credit card rate. I mean the interest rate set by the Federal Reserve Bank, known as the federal funds rate, which is the interest rate that your bank pays to borrow money. So although they don't directly change your mortgage rate, they change the interest rate that your bank has to pay to borrow money because your bank borrows money before they lend it to you. So when your bank borrows money for a lower interest rate, then they can ultimately lend it to you, generally at a lower interest rate as well. And the Federal Reserve Bank raised interest rates a lot after we saw the inflation problem as a way to help cool down inflation. Then they started cutting interest rates a few times because they felt that inflation was under control. And now by cutting interest rates, they can stimulate the economy. Because when interest rates go down, it makes borrowing money cheaper. And when borrowing money becomes cheaper, people spend more money. Not because, well, they have more money, but because it becomes cheaper to borrow debt. Remember, we live in a spending-based economy, but more specifically, a credit-based economy, which means people spend money not based off of how much cash they have in their bank account, but based off of how much credit the bank is going to extend to them. So we live in a credit-based economy, and when things go on sale, people tend to spend more money. It's the same with debt. When debt becomes cheaper, people tend to spend more money. So why does this matter? When interest rates go down, people can borrow more money, people can spend more money. That helps grow the economy, that helps grow markets. And this is where the Federal Reserve Bank says, we don't want to cut interest rates right now. We want to take it easy because we don't know what's going to happen with the economy. We'd rather be cautious. If we cut interest rates too much, we can reignite the inflation problem, and we don't want to do that. Now, the thing that I want to remind you about this is the Federal Reserve Bank says that they want inflation to fall to 2%. They don't want 0% inflation, they want 2% inflation. I want you to understand what that means. They don't want inflation to go away. They don't want inflation not to happen. They just want the rate of inflation to cool down. So they want the rate of inflation to fall to 2%, which is where we're not at yet. We're still higher than that. And so for people that are thinking about, well, are the prices of things going to fall? Are things going to become cheaper? That's not the intention of the Federal Reserve Bank or the government. The intention is to see the prices of things rise not as fast as they were before. And this brings me ultimately to number 3, tariffs. Now, I've talked about this a few times, but there's a lot of interesting things going on with tariffs. First they get started, then they get paused, then they get started, then they get paused or kind of paused. And the thing that I want you to understand is that tariffs ultimately are a tax. And it's a tax paid by the user. Meaning, if I'm a business and I'm importing a product from Mexico, Canada, or China, and now I have to pay a tariff on that, that means me as the business have to pay an additional 25% fee, a tax, penalty, call it whatever you want. When I pay that extra fee, I have a few options. I can either A, eat up that additional cost and shrink my profit margins, or I can charge you more money when you buy my product. So if I'm importing, let's say, ice cream from Canada, and now I have to pay $2 as opposed to $1.50, well, now either I can sell you the ice cream at the same price, or I can raise the price of the ice cream that I sell to you. And this is where we have a lot of uncertainty, a lot of confusion. And this is from the government level, this is from the business level, where a lot of people just don't know what's going to happen, and it's creating a lot of confusion. This is why we're seeing so much volatility in the stock market. When we hear the news about more tariffs starting, we see markets go down. Then when we hear news about tariffs being paused, markets go up. There's a lot of volatility because there's a lot of uncertainty. And this might be one of the reasons why we're seeing more businesses say, we're going to hold back a little bit on business investment because we don't know what's going to happen in the economy tomorrow, next week, or next year. And so before we make a big investment decision, before we invest billions of dollars or take on this huge loan or take on this huge project, let's wait and see what happens to our economy with inflation and tariffs and interest rates, because there's too much uncertainty for us to make these big drastic decisions. And so while tariffs could potentially bring manufacturing back to the United States. They could also bring more tax revenue for the government. It creates more uncertainty now because we're in such an early phase. We don't know the extent that these tariffs are actually going to stay for, or what they're going to be, and for how long, and for what duration. There's a lot of uncertainty now, which is why there's a lot of volatility. Now, this creates a lot of fear and panic for many people, but it also creates opportunity, which depends on what type of investor you are. If you are a long-term investor, say you're investing in the S&P 500, well, you're just looking for opportunities to potentially buy more if you believe in the long-term health of the economy. Now remember, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But you just gotta know your strategy. If you're a long-term investor, the day-to-day stuff doesn't really matter. If you are looking for more investment opportunities, you're looking for more individual companies, you're looking for more of those shifts, great. You're just looking for a good buying point where people are selling off because they're freaking out, and now you can find the opportunity to come in and buy. That's what Wall Street is doing. Wall Street is looking for the opportunity. They're gonna get rich, they're gonna build wealth no matter what's happening. They don't care about the emotion, they look for the opportunity. That's what financially savvy investors do, and that's what I want you to do. So again, if you wanna stay up to date on what's going on, I have a few resources for you. Number one, I'll try to keep you posted here on my channel. Number two, my team at Briefs Media publishes a free newsletter called Market Briefs. I have that link for you down in the description. And number three, I have my workshop on March 11th. If you have not registered yet, I have the link for you down in the description.